Hi there, intelligent investors and future billionaires. Welcome back to our channel, where we help people achieve their financial goals. We have a great deal for you today, a comprehensive guide on how to jump right into the exciting world of stock market investment. As many of you might know, putting money into stocks is a strategy to grow it over time. Over time, you might witness its worth increase if you consistently set aside funds for investments. Due to such factors, it's critical to get started right away, as you have the funds available. The larger your window of opportunity, the better. This video walks you through the basic principles of stock investing, including how much to invest, which stocks to buy, and other key subjects. You have enough to start, regardless of whether you have thousands saved up or can only afford to contribute $25 per week. How to begin buying stocks. Number 1. Make the right investment. Now everyone, let's begin with the first golden rule: purchasing the appropriate investment. You may be asking yourself, how do I pick the next big winner? And I understand. Hold on to your hats, because we are about to give you some very important advice. Purchasing the appropriate stock is much simpler said than done. Anyone may observe a stock that has performed well in previous years, but predicting how a company will perform going forward is far more difficult. You must be willing to put in a lot of work to handle the investments and do a thorough analysis of the firm. If you're going to be successful investing in individual stocks, it's a very tough game for anyone to win over time when you begin to look at statistics, because experts have been looking at every single one of these businesses with a lot more precision than you are capable of as an individual. It will be challenging in favorable conditions to investigate the businesses and predict what will happen next. Number 2. Avoid individual shares. If you're new to investing, it calls for more than just analyzing historical data. It involves making predictions. Don't worry, we've got a professional guidance on how to evaluate businesses so you aren't just throwing darts at the board. Keep in mind that this is a marathon, not a sprint. Everybody has heard someone discuss a huge stock victory or an excellent stock selection. Number 3. Develop a portfolio with diversity. We have some serious advice for all of you beginners out there right now. Stay away from individual stocks at first. Yes, you did hear me correctly. Making it huge doesn't need you to be the wolf of Wall Street. The finest thing for you is diversification. Consider it like a bunch of stocks as opposed to placing all your money in the red. Having a variety of equities available to you right away is one of the main benefits of investing in an index fund. For instance, you will hold equities in hundreds of firms across several industries if you purchase a fund with a broad range based on the S&P 500. A fund specially diversified and concentrated on one or two businesses is another option. The benefit of diversification is that it lowers the possibility that a single stock in the holdings can significantly impair overall performance, which raises total returns. On the other hand, if you purchase a single stock, it's as if you're putting all your eggs in a single basket. Buying an ETF or mutual funds is the simplest approach to building a diverse portfolio. You don't need to carry out any investigations on the firms included in the index fund, because diversity is already included in the goods. Diversification extends beyond owning a large number of different stocks. Additionally, it refers to investments dispersed throughout several industries, as stocks within comparable sectors could trend similarly for the same reasons. Number 4. Be prepared to experience a decline. Now fasten your seatbelts, because the trip of an investor is not without its ups and downs. What's actually at stake? Maintaining composure while the market heats up. Gain the ability to withstand adversity, ride out downs, and rise from a challenge stronger. For most investors, accepting a loss on their assets is the toughest thing to do. Additionally, since the stock market is subject of fluctuations, losses will occasionally occur. You'll need to toughen yourself to bear these setbacks, or you could be apt towards buying high and selling low during panics. Performance as long your portfolio is diversified. If that is the case, purchasing individual stocks may not be the best option for you. No matter how hard you try, you cannot completely eliminate your risk, because even index funds will fluctuate. Whenever the market shifts, we tend to be interested in withdrawing or to reconsider whether we are willing to continue. Because of this, it's critical to be ready for sudden downturns. like the one that occurred in 2020. To obtain alluring long-term returns, you must endure short-term volatility. Since stocks don't come with any guarantees, investment entails a risk of financial loss. If you're hoping for a return that is guaranteed, a high-yield CD would be a better option. Number 5. Continue making investments over time. It's simple to assume you're done after throwing all your money into the market. However, real wealth is created gradually by increasing investment amounts. This entails practicing strict saving discipline and setting aside a portion of your income so you may invest it in the stock market. Your wealth will increase even more quickly as you can invest additional money. Why join the stock market as an investor? If storing away money is the act of saving, investing is the act of putting money to use. By investing, you attempt to outpace inflation and presumably provide some extra returns by letting your money grow with greater diligence than it might in a saving account. But you also put your money in a great danger, since your pension fund will be placed in the fund that is composed of a variety of assets. If you have a pension, you already qualify as an investor. You can also participate actively in the management of this fund by owning a SIPP, self-invested personal pension. However, if you have a specific objective or time horizon in mind, you may also have non-pension assets to aid in the growth of your funds. This simple tutorial on how to start investing is for you. If you want to be a committed investor or just have a better idea of where to begin. Benefits and risk of stock investing. Last but not least, stay focused on the goal. Stay away from the traps of day trading and maintain your dedication to gradually increasing your money. Similar to a roller coaster, the market has dips along the way. Now let's buckle up, maintain our focus, and ride this trip together. Individual investors may hold shares in some of the biggest companies in the world through the stock market, and doing so can be quite profitable. All things considered, stocks are an excellent long-term investment if they are bought at fair prices. For instance, the S&P 500 has produced an annual return of around 10% over time, in addition to a respectable cash dividend. For long-term investors, investing in equities also comes with a good tax benefit. You won't be responsible for paying taxes on the profits if you don't sell your shares. Only the money you get, such as dividends, is subject of taxes, so you never have to pay tax on your earnings and may keep your shares for eternity. You will be responsible for paying taxes on capital gains on any profit you make from selling the stock though. The tax treatment of the stock will depend on how long you own it. Should you purchase and then sell the item within a year, it will be considered a short-term capital gain and be taxed at your income tax rate. If you decide to sell the product after a year of owning it, you will be subject to the long-term capital gains percentage, which is often less. You can deduct losses from your taxes or apply them to your earnings if you have any. Even if the market has done well overall, many individual stocks have underperformed or even failed. These stocks ultimately lose all of their value and are worthless. However, certain stocks like Apple and Amazon have been rising for years, returning hundreds of times the initial investment to investors. Tips for new investors. Your actions are one of the most significant and perhaps most crucial aspects of your performance, regardless of whether you created an account with a brokerage or an advisor-led account. Here are 3 crucial suggestions for new stock investors. Even though investors are typically portrayed in Hollywood as aggressive traders, you can outperform most professional investors by employing a passive buy and hold strategy. A single strategy in an S&P 500 index fund that tracks the top businesses. Tracking your portfolio may be beneficial, but use caution when the market declines. To feel comfortable today, you could be encouraged to sell your stocks and deviate from your long-term strategy, which would impair your long-term returns. Think about the long term. To prevent surprising yourself, it is useful to look at the assets only on specific days, such as the first of the month or during tax season. When it comes time to first start making investments, the globe of finances could seem scary. Enough is left to learn. One advantage is that you may work at your own pace, improving your knowledge and abilities before moving on when you're comfortable and ready. Final verdict. And now you have it, everyone. The whole manual on how to master the stock market. Please remember that the only wrong choices is that which you choose not to make. I hope to see you in the future and happy investing. Look for companies that have a solid track record of growing revenue and profit over the long term, do not carry a lot of loans, and are selling at reasonable prices, as measured by the ratio of price to earnings or similar valuation yardstick, to avoid buying expensive stocks.